that respond to the assessed risk. And in order to enforce this, the supervisor will need to have skills that challenge the common bank practice of extend and pretend loan, restructuring, as well as transfer to unconsolidated but de facto affiliate entity. And the supervisor also need to understand broader business interests of the bank owner as well. So moving on to the next slide. It's about building capacity to manage risk volume of bad debt. And the first part is about the method to manage, recover, and resolve non-performing loan. So there are four mechanisms to manage risk volume of bad debt. The first, the first mechanism is loan restructuring. So loan restructuring refers to the process in which borrower face financial distress or financial or liquidity difficulty, so that the bank deal with this by renegotiating the term of their payment to restore their financial stability of the client. And the second mechanism is the legal action or the legal enforcement. The bank doing this by sending the notice to the debtor with the notice period of payment. And if the debtor still cannot pay the money for their loan, then they will need to go to court and the bank can sell the collateral. And the third mechanism is write-off. So write-off refer to the disposal of the loan when all the measure of loan has been input into the customer but they still cannot pay, and it acts as the formal acknowledgement of the uncollectible of loan. And last but not least, the mechanism is to sell that to the third party. This is also part of disposal of loan in which they sell to the third party that might include asset investor and public asset management company. And in this case, the third party will continue to collect the payment from the customer. Uh, Now we move on to the next part, um, which is about the challenge to address this um, NPL in practice. Since the mechanism depend on the restructuring framework, it is very challenging for bank to do it because the mechanism above that I have present earlier applied differently depend on the status of borrower. So there are two status of borrower, which are the viable or cooperative borrower and non-viable and uncooperative um, uh, debtor. And they are assigned to different mechanisms in which the cooperative debtor can, in which the bank can um, assign the customer to those four mechanisms, but the non-viable and uncooperative customer can only the bank can only implement the legal action, write off, and sell only. So there are quite challenge for this um, the because of the challenging environment for the legal enforcement in the emerging economy. So those economy will depend more on write-off, which consider as the no prospect of recovery loan from the customer. And for full tax deductibility, it would grant only after obtained ruling, which which is very difficult and time consuming for the bank. And last but not least, accelerating the write-off can help bank management to turn its attention to fresh lending. So that's the end of my part, and we move to the next presenter.
Thank you. And for this part, it continue from the previous part. And first is organize seasonal need to manage rising volume of NPL and to control the increase in the amount of bad debt. Bank will have to set up their effort to that important such as business or model, organizational structure, strategy, and internal resort to reclaim previous loan, and by starting to strengthen the internal capacity to work out rising volume of NPL, bank can avoid becoming overwhelmed or moratorium pass out and asset quality issue emerge on their balance sheet. And some advanced countries have adopted an hand-on approach and require bank with asset quality difficulty to articulate NPL reduction strategy that is a comprehensive action plan to achieve qualitative NPL reduction target. Nevertheless, emerging economy may benefit from more proactive supervisory engagement in bank NPL reduction effort, creating an independent unit to deal with NPL. We have to eliminate potential conflict of interest between or, or, or originating officer and the borrower and build up expertise. And second, system-wide NPL resolution. Banks have primary responsibility for managing distress loan. One intervention is to set up national NPL resolution strategy that establishes policy, priority, and coordination mechanism based on comprehensive identification of obstacles to NPL resolution. In reducing high NPL, require the participant of broad range of stakeholders to align policy represent of private sector entities such as bank, institutional investor, and third-party service provider, and national authority, civil society, and uh, international financial institution. The working group identify four strategy priority. First is improving bank capacity to deal with NPL. Second, in net, enable condition for develop of NPL market. Third, improving and promoting out of court restructuring and improving and encode debt and mortgage resolution framework. Next slide. And so the last part is talk about dealing uh, with problem bank. Next slide. And first, it's about building capital strength to absorb loss and finance recovery. And banks were encouraged during the pandemic to utilize buffer above the minimum regulatory standard. Many banks have strengthened their balance sheet and create capital and liquidity, which has been under global regulatory standard. In some countries, the improvement in report uh, capital adequacy ratio may have been driven by a shift in bank lending toward assets that carry a low risk weight. The consensus is that uh, regulatory reform has contributed to stronger buffer that have helped banks weather the crisis and continue to provide credit. In countries that banking system suffer from pre-existing vulnerability, however, pressure from step increase in the program loan may be increasingly difficult to absorb. And second, um, taking early action to strengthen the capital strength of banking system have to guard against under capitalization and potential distress. Some countries has used far favorable global financing condition as a window of opportunity to raise capital, utilizing this window to raise longer term finance would also strengthen the funding position of banks that draw on external wholesale market as a source of finance. Recent events suggest that a failure to respond effectively to an undercapitalization of a banking system can be very costly to an economy. To protect against the risk of poor recovery due to weak credit and bankruptcy, bank managers should strengthen their oversight and analysis of individual banks in addition to the overall banking system finance for position and outlook for domestic privately owned bank re uh, capitalization process are likely to depend heavily on market conditions and the risk of investor, which in turn will depend on the bank business plan and outlook for the banking system. So that's all from me. The next part will present by the presenter.
Uh, Thank you, Bernard. So moving on to my part, which is strengthening the framework to address bank failure. So why is it important to strengthen the framework to address the bank failure? So at first we have to know what is the impact that the bank failure caused that we have to strengthen the framework. So unlike the failure of any non-financial company, bank failure can generate significant wealth loss to the economy as a whole. So it associated with disruption that is a provision in the physical financial system. So in addition to the bank fail, it may cause the knock-on effect that will be destabilize the rest of the financial system as well. So another limitation of the corporate insolvency framework when applied to the financial institution is that it does not recognize the particular position of the bank depositor. Who is the creditor of the non-financial company, as well as numbers of professional market in the participants, where it can be by the function of economy, the market economy itself. So um, for the regulator, the introduction of the effective crisis management framework has been very important priority for many years already, and it's complementing multiple initiatives to strengthen the resilience of the financial institutions and the system as a whole. So the international guidelines are useful in developing and implementing national framework. And in 2014, there's a Financial Stability Board issue a key, which called key attributions of effective resolution of emergency and financial institutions. So with this guideline, it is an information sharing on the sector specifically and on the implementations. So uh, there are four main tools to strengthen the framework of of the bank, which just like I have listed in the slide. The first one is partial asset and liability transfer. So this refers to transfer and ensuring deposits to a healthy bank with a corresponding value to performing asset. So the remaining bank book it would be rolled down. So in this example, I can raise a real scenario that uh, when when a startup bank um, has joined in the banking career, example like um, Chipmunk, once they join in a banking sector, so they are a very new bank. So they have to find a backup that can backup them in the case something happens. So they find another bank which they think is reliable and a healthy bank which everyone has trust on. So they will deposit their balance in there. So in the case that they have a risk in assessment or set, the bank will cover them. So just like this example, the objective of this tool is to avoid the cost and the risk of financial stability and of liquidations and depositor payout. So it will lower the risk of the fire sale of the asset. So another point is about the bridge bank. So this the meaning of this is to transfer performing asset of the proportions and liability to the government-owned bridge bank, which in the remain book is liquidate. The object of this is to avoid the cost and the risk of financial stability of liquidations and deposit payout, as well as the low risk in the fire sale asset as well. So the third tools that used to strengthen the banking framework is that to write down and convert the loss that observed in the bank or the loss that the bank has lost into a resolution into inequality. So the objective is to restore the balance sheet and to maintain the continuity for a large complex bank, and it is to avoid the cost and execution of risk and the bridge bank in terms of the bridge bank as well. And the last part that has to strengthen the framework of fair bank is uh, liquidation. So this is um, to liquidate the part or all the banking book. So that is to pay out and ensure the customer is not previously transferred to another bank. So the objective of this is to support market discipline, and it may be used to alongside with other tools. So, uh, so with this strong safeguard are integrated to resolution framework because it is an intervention tool that can override any shareholder or major normal decision or power in terms of interest. And these key safeguards um, are that the hierarchy of the claim liquidations must be respected, and no creditor will be worse off from undertaking the resolution that is under fall in the option of liquidations. Moving on to another part, um, which is about planning for dealing with the failed bank. Uh, can you move the slide to planning for dealing with failed bank? Yes. Thank you. So, uh, yes. We have planning is very essential to ensure that the resolution authority has information and tools to support orderly implement. So, uh, for over the last decade, authority worldwide has made significant progress in developing and implementing this resolution framework. They have also taken steps to strengthen other key aspects of the financial safety net, such as um, a deposit insurance scheme, which have support depositor confidence in the banking system. A strong framework have support authority in addressing failed banking, in a restructuring and strengthening the bank system, which help improve resilience, the meeting of the financial pressure in the economy as well. So, um, moreover, there may also be some practical challenge in applying this policy, particularly in the context of widespread asset quality, weakness, and the system-wide distress. So, open banking well in the strategy, for example, may prove a difficulty to execute because it is generate a lack of observing financial instruments that can be built in and just a couple of difficulty ensuring the eligibility of liability in the high market value. So um, purchasing and assuming PAA strategy that seeks to transfer assets to a strong bank may be difficult to arrange if the entire sector is financially stressed and the architect is taking over the limit. So, so uh, the use of public money should be the last resort. deploy in the private sector solutions that have been exhaust and also remedy attack and demonstrables threat to a financial stability and critical financial service that cannot be taken over easily by any other provider. So um, before 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 the arrangement of anything, government the government funds such as the temporary capital injection and resolution funding may be needed to preserve a confidential and financial stability and to drive an orderly, speedy restructure and thereby facilitate the rebuild financial system health. So before all of this happens, it is the first important step that have to be recognized to identify whether it is a failed bank or not, and to conduct all the plan. It is to ensure that all the loss is recognized and um, all the loss is shall be recognized before any government capital injection to avoid bail-ins for shareholders as well. So to ensure strong accountability, there shall be a transparency on the extent of the cost of the public support and recovery as well as the clear plan to exit. Yes, so moving on to the conclusion to sum up this presentation. Yes, so to sum up, dealing with wrongly a comprehensively with a distressed asset and a problem bank is essential for a well-functioning banking system and a healthy and a sustainable growth economy. So in order to avoid such scenario that we have mentioned, like avoiding such scenario that we have mentioned is a priority for any state and any banking sector. So um, replicating the full range of policy discussed that have been discussed in this chapter is particularly a demand for countries that face a combination of institutions constraint and a serious pre-existing financial sector vulnerability. Um, so what in some countries, however, entering a pandemic with a lax regulatory definition and ineffectual supervision. So in this country, the critical that regulate and supervision um, does not sum up the pressure of the further the regulation standard and sustain the supervision enforcement. So uh, when this happens in a country, if it goes upon a national level, the government should be coordinate the participation of the public bank and of the public and the private sector stakeholder as well as the civil society in representative to resolve the banking sector problem as soon as possible to avoid a financial instability in the country. So such institution coordinations would be particularly useful in the jurisdictions where effort can be accelerated in the um, NPL's resolution phase, major legals implemented and the tax obstacles. So moreover, IMF and World Bank could be also helpful by providing the assistance and advice in terms of strengthening financial supervision, including on the NPL identification as well as the strategy to resolve the NPLs. So strong crisis management framework that include a resolution toolkit for handling bank failure as well as contingency planning for dealing with the potential problem will help to protect taxpayer while ensuring the the flow of keep going the flow of the financial service as well. So that's it for our presentation. Yeah, and we have a discussion questions later on. Hello, like
Yes. So I'm done.
yes, yes.
Okay. Okay. First, I think it's a very comprehensive presentation about the bank and the non-performing loans, and it's one of the very important topic for banking sector. I just have a few quick questions, not for everybody. The first question is for Vishal. Can you explain a little bit what is the Basel Committee on Banking Supervision? What is the role of this organization and where they come from? And so can you elaborate on that a little bit?
Yeah, sure. So, can I have a minute to check? Okay. Wait.
Hello, Vishal. So you get
Oh,
the question, right? My question is about the Basel Committee on Banking Supervision, which uh, in short BC, and uh,
yeah, sure, yes, sir. So, the Basel Committee on Banking Supervision is the primary global standard setter for the prudential regulation of the bank and provide a forum for regular cooperation on the banking supervisory matter. It uh it it has a 45 members comprising central bank and bank supervision for 28 jurisdictions. So that's all for me.
okay, yes. Thanks to Vishal for the answer. So I think so is the uh,
Sorry,
uh,
teacher, can hear
the
you.
member
But
of this Basel
Hello,
and the
like
goal of this Basel agreement. Yes.
yeah, I think your
Hello.
internet is kind
Yes.
of slow. Hello, like can you clarify your question to our group again? It was kind of slow earlier.
Hello, everyone. Can you hear me?
yeah, yeah, sure.
Okay, so I think the Basel Agreement is the international agreement, and the member who signed this agreement are central bank, right, from different countries, and they set up the standard, I mean, regulations that a member country central bank, I mean, banking have to follow. So I think Cambodia is also a member of this Basel agreements. Okay. So I think the committee that you mentioned, they play a role in checking the banking system in each country. If they found it's not complied by the international agreements, then they will inform the NBC and to intervene. Intervene. That's what I can say about the Basel agreements. To Darlene, I have one question. You say there are way that we can dealing with the non-performing loan, right? And I interest in the third part where you say sell to third party, and you say that the bank can sell the non-performing loan to the public asset management company. Can you explain a little bit briefly what is the, I mean, after and what I mean after the bank sell to the public asset management company, what is the next, I mean, the process? Can you describe on that?
Thank you, teacher, for the question. On this part, when the bank sell the non-performing loan to the asset investor, basically they will need to discuss on the pricing and term of the sale for the bank non-performing loan, and then they will transfer the ownership right. Transfer the right of ownership from the bank to the investor, and then after that the investor will continue their effort to collect the payment from those NPL.
So it seemed like when for example, I borrow from the bank and then I have difficulty in paying, and so the bank actually sell. So I owe the debt to the bank. I have to pay back the interest. But now the bank sell the loan to the public asset management company, right? So I will have to pay interest not to the bank but to the public asset management company. Is that right?
uh, According to the article, yes, teacher.
Okay. So it seems like the bank is passing the 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 debt to the other party. So
uh,
they
uh,
become as I think if it passing it responsible to other party. Okay. So this is what I see. Okay. It could be dangerous somehow, maybe if the bank pay careless, just giving loan and then pass this debt to other party, okay, to bear the risk of the fall. Okay. But anyway, maybe they have reason for doing that, at least to help the bank to relieve the risk of failure when they have to face with large number of non-performing loans. I The last question I have is for Panyarot. You said the word under capitalizations. Can you explain that a little bit? What does it mean? Because generally the bank have the liability, which is the deposit, that money that people put at the bank. So this is the liability of the bank, and they have the asset, the loan that the bank providing to the borrowers. This is asset for the bank, and the bank have capital, their own money. And you say under capitalization. So what do you mean by that?
Yeah, teacher. And for the under capitalization, it means the, the bank they don't have enough money to run the business operation when when they uh, when they meet the crisis in the when they when the pandemic come, they have a financial crisis, so that make them under capitalization. That from my understanding, teacher.
Yeah, okay, that's right. Yes, thank you for clarification. Yeah, I think I agree. I think the capital mean the money of the bank, our pocket, the own money of the bank. You cannot run a bank without your own money. It's very, and your risk is very high. So when the borrower don't pay back and they default, right? You cannot use the deposit that people put money in the bank to pay that. It's to handle any other thing. You need to have your own money. Okay, then we call that capital or equity. So I think in some country it require to large extent before you can get license to run a commercial bank. You need to have a larger capital. Okay, you need to have your own money. You cannot earn business by just using money that people deposit at the bank and make loan. Okay. So this is very important, like you say, under capitalization. So they may need to find other shareholder that willing to put in the money the bank. Many of commercial bank in our country, sometimes they sell their own, capital to the foreign investor, like angel investor who take control of this bank. Okay, like the Hattha Kasikorn sell it to the Hattha Kasikorn Thai Bank. Okay, something like that. Okay, that's all for my question and comment. So you have the question, right, for our discussion?
Yes, that we do.
Okay, so this is the question from our presenter today. The pandemic and the associated policy response have significantly affect the financial position of the banking system. So what kind of policy that banking sector should consider to recover their positions? So everyone, is it okay with the questions? Can you explain a little bit about financial position, presenter? So what do you mean by financial positions? I know it's affected, but what do you imply by the financial position? Is it the bank making loss, or is it the bank is having an over indebtedness, or what kind of so our people, our member can clearly understand a little bit, okay, before we discuss.
It's about their loss that affects from
Okay,
pandemic.
okay, okay. Okay, so I think I'm going to put you into room for discussions. I think we have 25 people, so I'm going to put you into 5 rooms. Okay, and I advocate our presenter to support the discussion. Just wait a minute. Okay, room 1 I have Dalin. Room 2 I have Sun Ho and Dalia. And room 3 we have don't have anybody yet. And room 4 we have Panyarot and Visal. And room 5 we have nobody. Okay, so I'm going to get Visal to room 5. Just wait a minute. Okay, and I'm going to get let me see, I think I will get Dalia Sun Ho to room 3. Sun Ho. Okay, so we can start our discussion now. You have 10 minutes for the discussion, so you can start now. Okay, hello back everyone. Sorry to bring you back to the main room because we reached the time. So the next I'd like to invite each room to share the discussions. And I'd like to begin with room one, which we have in the room one, we have Dalin, Udom, Dane, Muni, and Senasa. Can you share your discussion, please?
Yes, so good evening, lecturer. So I am Sinasa, presenter from room one. So related to the question, so in order to uh, maintain or have the financial position during the pandemics, we propose some of the four policies. So the first one, the national banks to reduce the capital reserve requirement, which from the 12.5% to 5%. So the banks, the local bank or commercial bank can help more money in order to operate and also can do transactions. And another point is to reduce the rate or the debt rate. Like the bank can reduce the rate in their first years and their annual years. For example, some banks have a rate of around 6.88% in the first year, and in the second year, they allow the debtor to pay them with the rate of 7.88%. So in this case, the bank should reduce some of the rate in order to attract the middle income household family to run the firms, run the small business. And the third point is bank should conduct the deep analysis when providing the debt to the debtor. So in this case, when there is the intensive analysis through the household income of the loaners that borrow the debt from the banks, which they can have the ability to pay back the loan or not. And the last point, the fourth point is the bank should study whether debtor can repay or not rather than study about the collateral. So this case means that, for example, each bank before giving the loan to the debtor, they have to require for the collateral from the borrower. So in this case, rather than looking to the collateral, they should study more about rather the debtor can pay back or not. Yes, and this is all for our discussion. Thank you.
Okay, thank you, Sansa, for sharing the idea from room one. Let me invite room two. We have Chimain, Sepit, Seha, and Dalaya, please.
Yes, good evening, teacher. So, in our discussion, we raised 2 points. The first point is the problem of NPL, the non-performing loan that is arising during the crisis. Because so the first solution to that is to revise the focus and also the policy um, in order to avoid the NPL. For example, um, during before the global pandemic, some sectors such as real estate sector, for example, that sector was really in the focus, and there was a lot of investment, and the developers in that sector um, tend to borrow a lot. So they were in debt. But when the crisis or the pandemic immediately post, then they were in a high debt and they could not pay back. So this lead to the problem of NPL, and the NPL does not really um, um, give the problem to the investor, but also to the bank. So every party seems to have problems. So in order to solve this, the bank can restrict or reduce loans to the risk sector, in order to avoid further risk. For example, in this case, the real estate. For instead, the bank can provide or focus more into other sectors that could be more beneficial or have low risk to the loan. For example, the agriculture sector, like our government um, seems to focus on in the post-pandemic. The other point is the um, household loaning. For instance, instead of focusing on the big picture, we also focus on a small sector as well. So household is also important. So the bank, before loaning, the bank should also conduct analysis and learning about household background, the history of debt, and income to make sure that the household who borrow in order to invest could pay back in order to again avoid NPL. So this is all from our group teacher. Hello teacher, this is all of our group teacher.
Okay, hello everyone. Can you hear me?
Yes teacher.
Yes, sir, yes.
Yeah, seems the internet is so poor. Yeah. Okay. Okay. That's all. Can you hear me? Hello, hello, Chimay. Can you hear me?
Yes teacher, yes.
Okay, so it's all right for your group or your room.
Yes
Okay,
teacher,
I'd
this is
like to
all.
continue to room 3. We have Sikwang, Visal, Samnang, Tirik, yep, and Satyanit and Sunho. Can you share your discussion, please?
Yes, hello teacher. So I would like to share for our discussion. So we would like also focus on the credit risk and overall health of the banking sector in order to have the banking sector recovery from the pandemic. So we the bank like can reallocate credit, which like company should get the credit and bank should the line of credit be permanent, because bank credits to individual uh, uh, mortgage, real estate service, and construction constitutes a big proportion of the total loan. So before issuing a loan, banks like must assess their capacity, such as the ability to repay the interest in full back to the bank, and therefore the credit risk like could be building up due to over leverage in unproductive sector and at the individual banking institution level. So this is all from our group.
Yes, thank you, room 3. So let me invite room 4. We have Panyarwat, Saina, Chandanit, and Tidan. Can you share your discussion, please?
Yes. So, hello, lecturer. So I would like to share the answer from our room discussion. The policy for the bank to recover their financial position of the banking system is to manage credit by extending credit for the customer, because when there is an increase in non-performing loans, and their borrower also struggle to make scheduled interest as well as principal payment. So the bank should extend credit to help their customers survive. So when they survive, it also benefit the bank as a whole as well. So this is all from our room discussion. Thank you.
Okay, thank you, Rufo, for sharing the discussion. So let me invite room 5. We have Kanita and David Lee here. Start, can you share the discussion, please?
Thank you, Shisha. So our own discussion come up with 2 points. So the first one, the central bank need to set their the requirement and interest rate lower so that financial institution have more capital for to loan to both firm and household, so that they can have be able to generate more income from by receiving the interest rate. And the second one is that for after they the central bank set out those um, monetary policy, they financial institution can start to restructure their credit by allowing the lender to by those bank, the commercial bank, to reduce the interest rate on loan, on especially on those non-performing loans, so that they allow the business to be able to run and make more loan from their institution, so that those institutions could be able to survive, and in the long run maybe they be able to bounce back, and the bank can make more profit, and in that sense the economy will generate more income, so that in that way the financial institution will be able to survive their financial institution. This is all from the discussion between leadership.
Okay, thank you, Darwin, for sharing your room discussions. Well, I think what happens is already some point quite important. Yeah. For example, about the requirements and about the analysis of the credit risk and the ability of the borrowers. These are all the key importance. So I do agree with that. And but one more thing I want to add to the discussion, I think regarding the regulation and regulatory framework, also very important. Generally, we see in the banking sector, and from the experience of crisis, financial crisis in the past, is that happening with the banking sector? It's likely coming because of the commercial bank are likely to be depending on the central bank to help them when there's a crisis. They believe that because they are the key, because banking is like our blood, okay, circulation in the whole economy. And if they collapse, then the whole economy would fall. And generally, they have an idea that central bank will or government will help them. Because of this, sometimes the commercial bank tend to be careless. So they sometimes provide loan just to without paying my attention. The borrower can pay back. I mean, they can take on any risk providing to risky sector like real estate too much. Okay, without diversifying the loan and so on. Okay, so so it requires that they have the regulations and in the commercial bank providing this compliant. For example, we need to provide a loan is being given to real estate sector, to other, or what kind of the non-performing loan, and it's the spirit of loan to not and to let the crisis happen. And I think you have holiday for 2 weeks, so it's a long day with your family, your friend and relatives, and we will meet again after the Khmer New Year. So goodbye.
Teacher.
Thank you, Cha. Goodbye.
Thank you. Goodbye.
Goodbye, teacher.
Goodbye, teacher.
Yeah, goodbye.